Welcome to Contra Guys. I'm your host, Todd MacSween, and today we'll be interviewing Philip MacKellar. Philip is an analyst and portfolio manager at Contra the Herd Investment Newsletter. He manages the Vice President portfolio with Contra's co-founder, Ben Stadelman. He's been with the company since 2011 and investing since 2004. The newsletter focuses on value-oriented and contrarian opportunities in Canada and the US. Phil himself writes for Seeking Alpha at the Globe and Mail and blogs about personal finance topics at mymoneymoves.ca. So welcome, Phil.
Well, thank you again for having me, Todd, and for all the work you've been doing on this YouTube channel so far. I really appreciate it, and I look forward to today's video with you.
My pleasure. Happy to have you here. So today we have a bunch of company-specific questions from subscribers, but first I'd like to ask you about the macro, given how interesting things have become. But more specifically, I'd like to know about inflation. I mean, it's a very hot topic.
Sure. Yeah, I would say on the macro environment, my thoughts haven't changed since the first time we shot a full-length video like this. And at that time, I said that valuations were high. And today I'd say they're also high. High to very high is what I would say. And then as for inflation, the debate right now is whether inflation is transitory or whether it's sticky. And I don't know which one it will end up being. On the one hand, you have dozens of articles or headlines every week saying it's sticky or talking about something that indicates that it's sticky. And then on the other hand, you have the bond market at least implying that it's transitory based on the 10-year yields around, say, 1.5% or thereabouts. So that's the dichotomy, and there you have it in a nutshell.
Yeah, I mean, it certainly is. So, I mean, if I had to put you on the spot and say sticky versus transitory, which would you say?
I think I would say sticky, and I would say it's probably going to get worse. Well, what I would say is the risk from a policymaker's point of view is that it runs away on you. So I don't think the downside risk at this point is deflation. So if I were the Federal Reserve or the Bank of Canada or England or whoever, I would be more worried about it running away because inflation doesn't kind of progress or chug along in a lockstep. It spikes when it goes. So that to me looks like the risk, and I don't know if it will happen. The chart doesn't look that good, but I wouldn't be as sanguine as the central bankers currently are. So that's just my take. And to be honest, I try not to put too much stock in my own macro prognostications or that of others, really. So that is what it is there.
Yeah, true. Right? So I mean, in terms of not putting a lot of stock in those prognostications, I mean, could you speak to that a little bit more, maybe?
Yeah, I mean, macro is really hard. No two ways about it. Macro has a ton of variables that go into it. And if you get any of those variables wrong by a large degree, the whole theory is thrown off. So macro calls are often wrong by people out there. And my macro calls haven't been that great either. So plain and simple, it's hard. I don't have a very good track record of it myself. So I try not to put much stock in it. It's exciting and fun, I guess, to think macro, but I try not to get overly involved with it.
Yeah, no, I agree. I mean, some of the brightest minds I follow have got it pretty wrong lately with COVID and whatnot. So yeah. That being said, I mean, you know, you manage a portfolio. So how do you factor that in, or how do you?
Yeah, that's a fair question and a very good question. You're right, and you have to think about it at some level or try to do something about it. And as you know, I'm more of a bottom-up investor, which helps a little bit. My goal also with my portfolio and my money is to make sure that if I get the macro call wrong, I won't be killed. That's very important, not to be killed. And this means that my portfolio will grow more slowly than the person who really nails the macro call. The person who gets the macro call right will do much better. But the people who get it wrong will do much worse than I will. So I'll land somewhere in between, and it means I can keep going. So this year, for example, I've made 2 purchases for the Vice President's portfolio here, Contra the Herd, and both of those purchases had inflation in mind, or an inflation background, or a worse inflation environment was part of the thesis for buying both of them. But if I'm wrong, I think both of them will be fine if inflation decreases and it doesn't pan out the way that the sticky camp thinks it will.
So if inflation is sticky, how many positions in the portfolio would you say are strong inflation hedges or have some element of inflation protection?
That's a great question. So, what I would say is we own a REIT, and a REIT should be able to pass along rent increases on an annual basis. We own financials and some insurance companies, and those financials should be able to price better in a rising rate environment. We own a handful of miners, industrial companies, a construction company, all of which should also do okay to good, I would say. And then we have a few positions where on the spot, I wouldn't know either way. They're like consumer good companies. And then we own a utility and a telecom. And my guess is that those would be the two or the names in the sectors that wouldn't fare as well because they're highly regulated and it takes time to pass on consumer price increases. If you're a telecom company, your customers are locked into a fixed contract for a while. And if you're a utility, the regulators aren't going to just be right there for you, increasing the amount you can charge all the time. So that's what I would say there. I would also mention that while I have about 2/3 invested in stocks, about 1/3 of my portfolio, which is a little high, is actually in cash. And the thinking there is valuations are high. So whether it's valuation compression because inflation runs hot or valuation compression just because there's a blow off in the market, I think owning a bit of cash is not a bad idea.
Okay. Yep. Good plan there. Just thinking of the utilities. I mean, the other risk is interest rates rising because they carry a lot of debt as well. But
Yeah.
okay, so with regard to that cash position, I'm just thinking. I mean, in terms of inflation, I mean, are you concerned about that at all? Being a drag.
Sort of. I mean, if I have cash, which I do, the inflation will erode the purchasing power of that money if I were to go out and spend it on goods. But inflation will eventually, if it stays at the current level or increases, will eventually force central banks to increase interest rates. And that will increase the capital costs for companies. It will make it harder for them to earn money and erode their corporate earnings power. And then valuations will likely compress. The environment becomes more uncertain in high inflationary environments. So my anticipation would be that valuations would compress. And it's a case in so many things in economics. It's a case of being damned either way. You hold cash and you lose your purchasing power. You hold stocks and you watch their earnings power slowly eat away, and the valuations get eaten away too. So if the topic of inflation persists, what I would say is that our subscribers will be the first to know our thoughts on it because naturally we will start writing more and more about it in relation to our investments in each quarterly edition of Contra the Herd.
Sure. Okay. Well, that's great to know. Okay. Well, our first subscriber question, fittingly, is an inflation hedge. It's Gold Resource Corp. Could you speak to that a little bit, specifically with respect to the spinoff of Fortitude Gold and how that leaves Gold Resource Corp?
Yeah, sure. So the spinoff is complete. That's a great observation there. So we are getting a lot of questions about it. I would say that, like all resource companies, it could be an inflation hedge, and they are relatively able to pass along their cost increases to their consumers. But I think post spinoff, GORO is a bit of a mixed bag. Its share price reflects this as well. If you look at it year to date, it's down, and the shares can't really seem to gain much traction.
Yeah, I noticed in your April newsletter, you've taken a bit more of a bearish tone towards it.
Yeah, I have, and I'm not overly bearish, but I'm less optimistic on it, is what I would say. It's still on a buy list, and I don't plan on changing that. But the spinoff definitely created two very different entities with different growth profiles. And in GORO's case, the outlook for this year is flat versus last year. And that sounds okay, but you have to remember that in much of Q2 last year, they were shut down because the Mexican government implemented a COVID shutdown across the mining sector in Mexico. So it should have been an easy comparable to beat or match or exceed, and they're not going to do that. So that's a little unfortunate. And then longer term, they haven't provided a production outlook past this year. So that's also a negative. All that being said, their land package is absolutely huge. They have started doing exploratory drilling again in Mexico for the first time in years. Prior to this, it was all in Nevada, where the spinoff is now complete. And they're producing a lot of commodities which the world wants or needs. They have a lot of silver, lead, zinc, copper, and a bit of gold. And as you know, all those commodities are certainly in demand right now.
Right. Well, any thoughts with regard to their epithermal vein system and, I mean, the relatively short mine life, I think about 5 years? I mean, how does that play into your analysis?
Yeah, that's a great question. A lot of people ask that, whether it be people on the conference call talking to management, or you see it in analyst reports. And I think it's a fair observation. I would say an epithermal vein system like this is a mixed blessing. Yes, it has a low mine life for sure, but the mine life is also very stable. If you go back and look at filings, corporate filings from 5 years ago, 6, 7 years ago, you'll see that the mine life was roughly where it is now. So that's just the nature of this epithermal vein system. It's very hard and challenging to explore around it, but the more you dig it out, the more ore you generally tend to find, and that maintains the mine life. So it will eventually run out. All ore deposits do, but my guess is that in 5 years, the mine life will be similar to where it is now.
Okay. In that case, could you maybe summarize for us your views on GORO? I mean, how would you characterize
I
it?
would say it's a slow, steady eddy. They're not in terminal decline, and they're not growing either. It's just steady as she goes.
Fair enough. Okay. Well, no discussion about Gold Resource Corp or GORO is complete without talking about Fortitude Gold. So, what do you make of the spinoff, and what are your thoughts with it on its own?
Yeah, so I was initially against this, but it certainly created value. And as of right now, I'm more optimistic on Fortitude Gold for sure. But anyone looking at the stock chart of the two companies can see that my optimism is quickly getting priced in or being reflected in the share price. I would say that Fortitude is in growth mode. Their production, which was about 30,000 ounces last year, is going to increase to about 40,000 this year, which is great. And then it's supposed to increase or maintain itself at that level until 2024, which is good. Then on top of that, you can add on some very near site good deposits, which look like great exploration or development targets. And the ore bodies and the mining profile could expand further. So to me, it looks like a mini coupler. So for those subscribers who are familiar with Alacer and the coupler facility, it looks a little bit like that to me on a much smaller scale, but still has many of the same characteristics.
Oh, interesting. What about from a dividend story perspective? I mean, how do you see it?
Yeah, the dividend story is good. In April, they started a monthly dividend, which is unusual for a mining company, and they started issuing shares at 2 cents. And then a month later, they increased it to 3 cents. So they're coming out of the gate strong. They have a corporate presentation out there which says that they could increase it to 5 cents. Honestly, though, I think that's a bit far fetched. They would have to have a lot of things go right for that to happen, including things outside their control, like the price of gold.
Right. Fair enough. What about given the rally? I mean, would you still buy it, or what do you think?
Yeah, no. Making an initial buy limit on it was a bit challenging post spinoff, and I think I hazarded a good guess there, but my analysis could be wrong. I'm fallible after all, so we'll just see. The dividend is pretty big, which is good. So I might have to reassess that at some point, but no plans to do that right now.
Okay, good to know. I noticed it's also on the OTC. Why are they not listing on a proper exchange? What do you?
That's a good question. Yeah. So if you talk to management and you ask them, they will say they wanted to keep their costs low when they spun off, and they were worried that if they tried to list on the New York Stock Exchange right away and something went wrong, they would be booted off. So they would prefer to grow into the profile necessary to list on the New York Stock Exchange.
Sure. And do they then do plan to list on a larger exchange at some point?
Well, that's what they say. I spoke to the CEO in October before the spinoff was complete, and he said at the time, anticipate 6 to 12 months for a proper listing, was what he said. I have seen nothing on the corporate website or from the investor relations team since then, so that might be delayed, but we'll see. My guess is it happens at some point, which is great, but I don't know when. And that's unfortunate because many institutional investors can't hold OTC listed companies, so they had to sell prior to this spinoff going through, which really hurt because it has unlocked a lot of value for shareholders, but unfortunately those institutions couldn't participate.
Yeah, no, that's unfortunate. I mean, one advantage of being, I guess, a newsletter writer or a retail investor, you don't have to worry about that. But
Yep, that's true. You don't have any silly. Oh, I shouldn't say silly, but you don't have any restrictive mandates if you are a retail investor or a newsletter like us. I would say though that even as a retail investor, it's not easy to have a company do this. Here in Canada, for example, if you held it in an RSP or a tax-free account, you had to move that or sell it. So it could either be moved to a non-registered account or you had to kick it out. And I can tell you from experience, depending on who your broker is, that process of moving it to a non-registered account can be a real pain and a nightmare.
yeah, I'd imagine. Yeah. Well, let's not talk too much about discount brokerage nightmares. That's a rabbit hole. Okay, so in an email blast recently, you talked about Turkey. You actually bought a Turkish ETF. Do you want to speak to that a little bit, perhaps?
Sure. So it's the Turkey iShares ETF is what it is, and I've actually bought this a few times. I purchased it at $23 in one account not too long ago, and I think my average cost is about $19, and today the value sits somewhere in between those two. I'd say this investment is very deep value, very contrary, and it's not for fair weather investors who easily get scared out of positions because a lot could go wrong here. Inflation in Turkey is running very high. Capital flight is real, meaning dollars or money is leaving Turkey, and the central bank is struggling to prop up the lira. And that's difficult or makes it very difficult for companies and governments in Turkey if they've issued dollars or issued debt in dollars or euros, because now you're collecting revenues in lira, which is depreciating, but you still have to pay back your debtors in euros or whatever, and it's a bad situation. This is what drives some companies and many countries to bankruptcy from time to time.
And what is their inflation rate?
Well, who knows really? I mean, it's hard to say. Uh, but if you look at it, their consumer price inflation, their core inflation, and their food inflation are all reading about 17% as of May. And then their producer price inflation, which is often more volatile, is reading at 38%. So the answer is high. I don't know how high it actually is, but it's high. And what makes it worse is that Erdogan doesn't like high interest rates, and he stacks any central banker who tries to deal with it. So I guess kind of like central bankers here or politicians here, they don't like high interest rates.
Yeah, jeez. Well, I mean, and that even, that whole discussion doesn't even speak to the political, social, and regional military issues of Turkey. So
Yeah, no kidding. They have plenty of issues there. They have domestic military issues and issues with the Kurdish minority, and then all of their neighbors are frenemies, it seems, like the Russians and the NATO alliance and even the Greeks, and the list goes on. So yeah, they're in a tricky spot there for sure.
So in light of that high inflation rate in Turkey, how have domestic investors stayed protected, or how have they fared through this? I mean, what's sort of been the situation there?
Yeah, that's a good question. If they could own foreign assets, that would have been a good option for them. They would have done well there. Owning commodities, they would have done fine there as well. Owning their own stock market would have done okay. Owning domestic real estate would have done okay. But no matter where they go, it is a bit tricky if you're a citizen in Turkey figuring out where to invest for sure.
Sure. Well, that's a lot of negatives. So where's the positive here?
Yeah, it is a lot of negatives. The main positive is that Turkey is very cheap, and cheap is generally what I like to see first and foremost when I make an investment. And when you dig into it further, the ETF is fairly well diversified across many sectors. The top lines of the companies in the ETF are generally growing, and they're still profitable by and large. So they have been able to pass along their cost to their consumers. And then in the background, I would say, yes, the inflation picture is troubling, as are many of the other things we've talked about, but their demographics are very good, and their economic growth underpinning that is very good. And in fact, it's much better than I would say nearly all their NATO allies I can think of off the top of my head. Many countries in East Asia even don't have the same demographic and economic backdrop that Turkey does. So I like that dynamic. Again, it's not for the faint of heart. and you have to be willing to be wrong on it for sure. But it's something that I'm comfortable with for sure.
Okay. So I'm kind of wondering, was your decision to enter the Turkish ETF somewhat influenced by your past history with the Lasser Gold, which was acquired by SSR Mining and the Copler deposit in eastern Turkey? I mean, was there any?
Right. That's a good question. I would say yes and no. Yes, because having invested in Turkey through Alasar or SSR Mining, it meant I was a little more familiar with what was going on in Turkey. I'd experienced what it was like over many years, so that made me more comfortable. But then no, because I just like cheap things, and when I see something that is cheap, I will go and take a look. So I would have looked at Turkey regardless of had I invested in Alasar or not, based on the fact that the valuations were low, especially to places in Europe and North America.
Okay. Well, good to know. So, as long-term subscribers will know, back in 2014, GE spun off a company called Synchrony Financial. The very odd subscriber will know that you had purchased it. Could you maybe speak to that a little bit, going back a ways?
Sure. Yeah, it is funny how sometimes we do get an odd question about Synchrony. You're right, I do own it. Way back in 2014, I opted to convert most of my GE stock into Synchrony. And since that time, I've actually added to the position a few times, the latest time being in March 2020 when the world was just falling apart everywhere. And I picked up some shares at $19 and change. I should say, though, that Benj didn't convert any of his stock into shares. He kept all his GE position, and he still owns it for that matter.
What do they do specifically?
Right. Synchrony, what they do is they are a credit card company, and their closest peers are MasterCard, Visa, Capital One, companies like that. But unlike most credit card companies, Synchrony is largely a private label or a co-branding credit card. In co-branding, what that means is they will establish a relationship with, say, Gap or Lowe's or JCPenney, and then issue a Gap-specific or a Lowe's-specific credit card to their particular customer base. And this means that it's something of a hybrid credit card, if you will. They have store-specific opportunities and exclusivity for their customers, but then they also have the typical features of a credit card like rewards or cashback or whatever you have.
Oh, interesting. Okay. Well, it sounds like it's a bit of a niche within the financial sphere, or maybe even a niche within the credit card sphere, really.
Yeah, it is certainly a niche, but it's still quite competitive. In 2018, for example, Capital One poached Walmart right from under Synchrony's nose, which, depending on which analyst you talk to, that really hurt, and it was a big loss for the company.
So, sorry, just going back. So, why did you choose to convert some shares to Synchrony, and do you still like it? I mean,
Right, that's a good question. So, I would say I've just said how the credit card business is competitive, but it's not as competitive as GE's other lines of business. GE's in many, many, many divisions around the world, and their landscape on almost every front is very competitive. And the balance sheet looked better than GE's. The terms of the conversion were good, which was a big factor. Valuations looked fine. And then I thought that the cash flow generation of a credit card like company would be much better than the cash flow generation of an industrial like GE. And so far, those dynamics have played out. I wouldn't be a buyer of Synchrony at these levels or these days, but they have a very strong franchise, and the cash flows have been very good and supported decent dividend and buyback, and they can fund growth internally too, which is quite an enviable position to be in.
sure. So, I guess if we had to say buy, sell, or hold, it kind of sounds like you might be in the hold range.
Yeah, I would say it's in the hold range. If it were under $25, I would look at loading up more. If it were over 60, I'd probably look at lightening up, and that's how I think about it right now.
Okay, great. Well, thanks for those thoughts on Symphony. So, moving along here, we have a question about Manulife. In terms of insurance, how do you, in that business, how do you think the potential inflation that we're talking about might affect them, or rising rates, I should say?
Yeah, if inflation is sticky and if rates go up, financials, including insurance companies, should do relatively well, or at least they should hold their own. As for Manulife itself, I actually own it, so need to disclose that. it's been hurt like its peers, Great West Life and Sun Life, for a very long time because the low interest rate environment since 2008 has just crushed the margins that they can charge on insurance products, retirement products, investment products, and it just goes on and on. And if the inflation rate does result in higher interest rates, that should be a benefit for them because then they can price more liberally and they can make up for some of the margin compression that they faced over a very long time.
Yep, fair enough. So, bull or bear there?
I would say I'm neutral. Those who are really interested can go and look. Manulife has just had its 2021 Investor Day in late June, and they can read through many presentations and get lost in hours of conference call transcripts. To me, the valuations look okay for sure, but I think there are better opportunities out there. Operationally, they're doing well in Asia. They have lots of good progress and momentum there. Operating metrics, the debt metrics, they all look fine. New business value looks fine, but it doesn't really get me excited. And insurance is really tricky. Anyone who's followed the industry for a while will know that Manulife and its peers have had trouble pricing products of all kinds. It could be long-term care contracts, it could be annuities, guaranteed investments like segregated funds, long-term alternative assets. All of them have had to reprice and readjust, and the list just goes on. So insurance is a very tricky business to be in.
Well, thanks for those thoughts. Those are good thoughts with regard to Manulife. Changing gears a little bit here, I was looking through old copies of Contra. Not a lot of trades during the year necessarily between the two portfolios, but when you do have trades, often there are quite a few around the same time. Do you want to just speak to those patterns a little bit, perhaps?
Yeah, that's a good observation, and I'm quite happy to answer that because what I would say is that investing or successful investing, I think, is largely about sitting on your hands and doing nothing most of the time. I know that there are excellent day traders out there. There are really good macro traders out there, but I'm not one of them. And for me personally, I found it better the fewer decisions I make, the better I tend to do. And to your point about noticing the trades happening in batches or in fairly short succession, I would say that's very deliberate. Opportunities appear that way, so you gotta play the game that way. And current subscribers will know, for example, that in the first quarter of this year, in first quarter of 2020, we had a ton of a ton of sells in both portfolios, and so many of those companies had been in the portfolio for a long time, and then all of a sudden they were all hitting the sell targets or their value estimates, and it was time to kick them out. So yeah, I would just say that buying opportunities and selling opportunities tend to come in waves. And when there aren't those big opportunities out there, it's better for me anyway, just to sit tight and wait.
Sure. Well, it's nice to have a wish list and some cash for when those opportunities do present too. So.
Yeah, I would say it's very important to have a wish list and a research list ready to go when there are investments to be made or when things do look beaten up. You'll probably do much better if when you're heading into a crisis, you know 5, 6, even 10 companies quite well. And then on the flip side, once you buy them, you'll probably be well served if you have a fair value estimate in your head or written down or in Excel so that you can determine when you want to sell this company when it comes time.
Sure. Yeah, sounds good. I mean, do you ever, I mean, it's difficult, right? Being that patient. Do you ever get sort of frustrated with the sort of the amount of patience that it requires?
Oh yeah, for sure. I mean, I would love to sell a multi-bagger every single day. That would be great. I'd be fantastically rich and everything else. It would be amazing. And I'd love to buy the next multi-bagger every day, but opportunities just don't really occur like that. So yeah, it could be frustrating, and it could be frustrating for new subscribers too, because so much of the investment media out there says that that's how investing works, and it's just not the case. So what I sometimes remind new subscribers is that opportunities do come in waves, and while we're not that active, we do have very clear buys or holds when they get their issues of Contra the Herd, and then they can see, even though we have enough in our respective portfolios, it may still be listed as a buy, and they can go and buy that if it fits within their own portfolio dynamics and their own risk profile.
Right. That's good point. Good to note. Well, thank you very much, Phil. Appreciate you joining us today. Do you have any closing comments?
Well, thank you as always for setting these up. I really enjoy doing them. And I hope our subscribers, if you're out there and you're watching, I hope you're benefiting and appreciating the YouTube content that we've done so far. Stay tuned for more. And your next issue of Contra the Herd will be on its way to you on July 13th.
Excellent. Well, I'm sure everybody's looking forward to that. Thanks a lot, Phil. Appreciate it.
Thank you.
Take care. Hi, everyone. I hope you enjoyed today's episode. If you'd like free access to our paid subscriber content, just click the link here and enter your email address here. And don't worry, we won't spam you, but if Contra does ever offer a major discount to the newsletter, we'll let you know. Otherwise, you'll just be receiving our premium video content through this channel. So we look forward to seeing you there. Happy investing.